Hello, everyone, and welcome back to Class 8 Personal Finance. I want to talk about how not all international index funds are the same. If you remember this chart that I talked about earlier, then you're ready to go. If you haven't seen this, then you may want to, well, if you haven't seen this and you don't understand it right away, you may want to see my previous video where I explain what this is. It'll kind of look like that on the video thumbnail, and I'll explain it to you. But let's talk about international indexes here. Right here, I have VXUS, which is Vanguard's Total International Stock Index Fund. I also have the iShares diagram here. They have a fund called IXUS, that's a ticker symbol anyway, and it's the core MSCI Total International Stock Index. And if you look at, make sure I click the right one, this is the one. It's got a nice expense ratio of 0.09, and it has all of the nice developed and emerging markets countries within its portfolio. I totally skipped over it because I didn't click the geography before I started the video. And so you'll see it has Japan at 15%, United Kingdom at 10%, China at 8.5%, and so on. Now, here's why not all international indexes are the same. You might be looking at your 401k, or if you're military, ex-military, federal government, whatnot, you may have the thrift savings plan like I do. And you're scrolling through here and you see key features. The iFund offers the opportunity to earn a potentially high investment return over the long term by investing in stocks of companies in developed countries outside the United States. Okay? And it says the objective of the iFund is to match their performance of the MSCI EFI, Europe, Australasia, Far East Index. Now, two key things should fill you in right away if you're not immediately familiar with the EFI index and know what I'm talking about. One is that we're talking about developed countries. I should have pulled up the country classifications. So let me do that now. I happen to have it in a little text file already. It's also going to be in the description of this video, and it's in all of the descriptions of the videos so far. This is my third video that I'm uploading. And you go down here to MSCI's country classifications. Let me get my face out of the way here. Whee! I'm over here now. And unfortunately, I'm looking in the wrong direction, but that's okay. So, you have the developed markets. You have these in the Europe, Middle East, Austria, Belgium, Germany, Italy, United Kingdom, and on separate lines. That's okay. And you have your emerging markets, Brazil, Chile, Colombia, Czech Republic. China's that really big one right there. Now, go back to this TSP thing. Developed countries. By investing in the stocks of developed countries, i.e. not emerging markets countries. So, all of these countries in the, I clicked the wrong one. All of these countries in the emerging markets are excluded from the MSCI EFI index. You don't get any China. You don't get any India. You don't get any Korea, Malaysia, Philippines, and so on. Maybe you like that. Maybe you don't. Now, in the context of directing where the investments of U.S. military personnel is concerned, maybe that's a good thing. Maybe they don't want us investing in China and Russia and some other places as well. But think about this. Where is the one place where it's a developed country? And let's go back here. Okay. This thing is the EFI index, which is the Europe, Australasia, Far East Index. So we're going to play process of elimination here. What is a developed nation? Like, this is like a Western democracy. That is not the United States, because this is the iFund. It doesn't have the United States. That is also not in Europe, not in Australasia, and not in the Far East. Canada. Sorry, you maple syrup drinkers. We're not allowing the United States military to invest in you because you're just like China and Russia or something. Sorry. So yeah, the MSCI EFI index doesn't have Canada. Now maybe that's not too significant. You could check over here and just kind of get a read. Canada is 7.64% of the total international stock ETF. So I'm not saying you necessarily want to put a Canada fund separately in your Roth IRA. You could do that, but it's something to be aware of. Or maybe just direct your international funds only in the Roth IRA, or to the greatest extent possible to the Roth IRA. That's a way you could do it, or maybe you're getting too complex. But I mean, the point of this video is why these international funds aren't built the same. So let's go on here. So that's an example in the TSP. I also pulled up, your session is about to expire. Stay connected. So here's a look at my other 401k. It may reveal what my employer is. That's okay. If I see it, then I'll say that I'm not representing them. But I've got these different funds in my civilian 401k. It's got a stable value fund, government short-term investment fund, Bright Horizon, which is their version of target date funds. And down here, after you've gotten by why the S&P 500, 400, and not 600, but Russell 2000 because we're confusing, we go down to the International Index Fund. If you were to click through that, you would get to a fact sheet like this, and there's my employer. I don't represent my employer. Sorry. I don't represent my employer in this video series. But you go through this and you try to figure out, okay, what's in this fund? The fund seeks to track the performance of the Morgan Stanley Capital International Europe Australasia Far East Index, MSCI EFI Index. I move my face back over here. I think it's better this way. So this is tracking the same fund, rather the same index as this TSP one. Over here, it also excludes Canada. So there's not much you can do within the 401k about that unless you want to get really picky and go with some sort of self-managed account inside the 401k where you can pick individual stocks and actually choose an ETF that you want. I'm not doing that within mine because, one, the self-managed account looks like a pain in the butt to administer and actually get funds over it. Like, you actually have to send paper in to sign up for it and all that. And two, they actually charge commissions. They actually charge $6.95 a trade, and that's absolutely insane in 2022. That's the year, right? 2022. We're still charging commissions. Okay. So what other options do you have in terms of international indexes? So you have something like this. I mentioned VXUS before in a previous video, so I'm going to look at IXUS. There's another reason I'm doing this. That I'll get to in a sec. But this is the iShares Core MSCI Total International Stock ETF. It has an expense ratio of 0.09. Good and simple. You can see the individual holdings, and even Taiwan is number one in terms of the individual stocks because Taiwan Semiconductor right now is pretty darn important. Samsung is electronics in there. That should be your clue that you have South Korea, which according to MSCI, and okay, MSCI is the index provider in this case, it still has the emerging markets in there. You can also look through here at the exposure breakdown to see you have Japan and the United Kingdom, which are developed markets countries. China is emerging. Canada, that's a cool animation right there. Canada is developed, but not in the EFI index. France, Switzerland, Germany, Australia, all developed nations. Taiwan is emerging. India is emerging. South Korea, according to MSCI, is emerging, and so on. So you have a mixture of both, and that's all by market capitalization. It's based on the sizes of those companies, how much of those companies is on the public exchanges. Now, why am I going through all this? Well, you could get confused, and you could end up with something like, and kind of like how I'm confused scrolling through these things. If you're not careful, you could end up going with something like this. iShares, MSCI, EFI, ETF. Well, that's that same index, right? Yeah, it is. MSCI, EFI index, Europe, Australasia. Well, sorry. This one says Europe, Australia, Asia, and the Far East. Sorry, guys. And you'll see down here, Japan, United Kingdom, France, Switzerland, Germany, Australia. Sorry, Canada. Now, I don't know why you'd ever pick this ETF. Not only is it tracking the EFI index when you could be tracking this index, which includes Canada, unless you just don't like Canada or something. I like Canada. You could be using IEX US instead of EFA, and you'll have that Canada in there. Or how about this one? Where did it go? Did I pull it up? I didn't pull it up. I'm a moron. So let's use this one because I'm getting rid of it. I'm getting rid of EFA. We're going to go with IDEV here. And let me show you where I had IDEV listed. This is called IDEV. IDEV here is the MSCI Developed Markets Index. So if you split out the developed markets, split out all the international markets, all the ex-US markets, that is, into two, you have developed markets and you have emerging markets. The developed markets, ETF, oh, please load. Please load. There we go. So IDEV is the core MSCI International Developed Markets ETF, which is not the EFI index, and therefore it's going to be a lot like the EFI index because EFI is also developed markets only. When we click over to geography here, and Canada's there. Yes, let's drink some maple syrup. And if we go to over here, you have the emerging markets ETF that I mentioned earlier. Oh, by the way, that expense ratio on EFA was really big. I think it was above, it was somewhere around 32, 0.32%. IDEV is 0.05%. So why on earth would you choose EFA? Even though, hey, it's the same index and we're trying to make everything equal. Don't pick EFA, please. And IXUS, 0.09, which is less than 0.32, 0.35, whatever that was. Don't do that. Now you could pick IEMG as your emerging markets ETF. So say, for example, you have your 401k and you have your EFI fund in there, but you want to add emerging markets because you don't have the emerging markets in your 401k. You want to use a spreadsheet to try to get those roughly proportional, like an 80-20 ratio. You could use something like IEMG, which matches that MSCI EFI index in terms of what is a developed market and what is an emerging market. And the reason I say that is because if you mix, I've talked about this in the previous video about this graph here, but if you look at Vanguard's emerging markets fund, there's no South Korea. But Vanguard's developed markets fund does, because FTSE is a separate index provider, and they say that South Korea is a developed market. Now, regardless of whether you agree, I happen to agree that South Korea probably should be considered a developed market. It's a developed country now. Yay, okay. But I still have MSCI funds in both of my 401k type accounts, and I can't do anything about that. I can't make them change their minds. So you're kind of stuck with these MSCI classifications, and you have to get your South Korea exposure another way. If you want this emerging markets exposure, you have to be careful to make sure that you're picking the right emerging markets fund if you want to be exposed to all these things. Now, if you don't want South Korea, okay, great. I mean, you're not going to just fail to retire because you failed to include the right emerging markets fund. What I'm saying is you should be aware of what you're doing and not discover things later on. So you could pick this emerging markets ETF if you have an MSCI fund in your other accounts. It's got an expense ratio of 0.11, which is pretty reasonable. You scroll down here to geography. And you might expect China to be a pretty big chunk. It used to be like 40% in here, and I guess things have switched around with market movements. That was kind of the joke. Hey, all these emerging markets funds, they have like 40% China because it's broad and diversified emerging markets fund. That was Kyla Scanlon, by the way. I stole that from you. Sorry. She's probably not listening to this, but just in case. You have China, Taiwan, India, South Korea, Brazil, South Africa, Saudi Arabia, and Russia. Now, I mentioned in my last one of my videos, the one on portfolio construction. It covered this table here where I showed you how to construct a portfolio based on your stock and bond allocation and all that. And I told you, if you were watching this video, that I'm in the minority. I pick VEA over VXUS. VEA is the developed markets ETF. If you're going with just a plain old 4 fund that doesn't worry about emerging markets, because I like to avoid these autocracies. I prefer to avoid autocracies like China and Russia and Saudi Arabia, etc. I don't think the market properly prices the political risk in these countries. And at least in terms of China, I have at least been either correct or lucky over the past 2 years. China's done terribly. What can be done about this? Well, there are a few funds that can at least provide emerging markets exposure without at least China exposure. And I'm going to go through a couple of those here. One of those, oddly enough, comes from iShares. iShares CEO is Larry Fink. In fact, there's his name. Read Larry Fink's annual letter to CEOs. And he gets accused a lot of being kind of a China shill, bowing down to China or whatnot. I'm not interested in the political aspects of that necessarily. It's just kind of an oddball that iShares of all companies would have a fund like this. Emerging Markets X, that is excluding China ETF, and the ticker is nice and easy to remember. EM, Emerging Markets, XC, X China, excluding China. It's got an expense ratio of 0.25. When you see a net expense ratio versus an expense ratio, it's really this one, but they say, hey, we're waiving a portion of the fees. I don't think they're actually going to bring the fees back up. I mean, maybe they will. So don't take that as an absolute guarantee. For now, the expense ratio that you're paying is 0.25, and maybe the extra 3 isn't something you're particularly worried about. So yes, it is more expensive than the core MSCI Emerging Markets ETF. But when you're talking about excluding that much of the portfolio, that's going to make more of a difference than the expense ratio. So I wouldn't let the expense ratio sway you on this one if you're actually intentional about getting China out. And so if you look at the geography, Taiwan, South Korea, India, Brazil, Saudi Arabia, South Africa, Russia. So it didn't exclude all of the autocracies. It just excluded China, which is what it said it would do, and it's a cheap way to do that. So maybe that's something you would consider. I used to hold this fund. An alternative that's out there is Xcem, which is by a firm called Columbia Threadneedle. Don't ask me why it's named that. It's weird. But they basically do the same thing. The expense ratio is 0.16, which is pretty nice. I don't know what the bid-ask spreads are on here. Well, it's right there. Median bid-ask spread is 0.43, which is pretty high. So if you don't know what a bid-ask spread is, when you buy an individual stock or an ETF, there's a difference between the bid price, which is what someone is willing to buy it for, and the ask price, which is what somebody is willing to pay to get it. And there's a spread between that, and the idea is, okay, that's going to be 0.43 on average. And so when you're buying this ETF, you're going to have to pay the ask price, and so you're not getting the true price necessarily. That's what that is. So you want smaller bid-ask spreads, and that's kind of a big one. And these bid-ask spreads are a big reason why you don't want to be nitpicking with your asset allocations when you own ETFs, because you'll incur transaction costs, even though your brokerage almost certainly doesn't charge, $5 to $10 commissions at this point. So that's Xcem, and the bid-ask spread's a bit high, but the expense ratio is pretty nice, so it's kind of a trade-off. And then there's this one. Full disclosure, I own this one. I own quite a bit of this one. This is FRDM. That's the ticker. It's the Freedom 100 Emerging Markets ETF. And the idea with this one is they start with the 26 emerging markets from the MSCI index. They're using the MSCI definitions, so this is going to include South Korea, which is a very free country. They take out countries with not enough market capitalization, so like the market's just too small to invest in. Then they freedom weight them. So they don't weight them by market cap yet at this stage. They're using third-party measures from, I don't know what Fraser Institute is. I know what Cato Institute is. But the idea is that they are measuring by personal and economic freedom and weighting the countries that way. After they've weighted the countries, they exclude state-owned enterprises and then select the top 10 stocks in each country and then market cap weight those within the country weights. And so what you end up with is this right here. Is my head in the way? No. You have Taiwan being number 1, Poland being number 2, South Korea number 3, Chile number 4, and so on. And so you're taking some very different country weights. Let me see if I can separate this out. And what I'm going to do, bad, not what I wanted. I'm going to go over here, and then we're going to, so we're going to use the iShares Emerging Markets ETF as our base because it's based on the index, and so these weights are going to be the same as the index if they're doing their jobs. So if we can put these side by side, and I can make this work. Now you think I'm on a phone. Thanks, guys. Exposure breakdowns. There we go. Come on. All right. That'll work. So China is number 1 within the iShares fund and within the MSCI Emerging Markets Index at 29.31. China's not there in FRDM. And it's not because they excluded China because it's China. They excluded China because the systematic weighting excluded China because they're just not free. The person who runs this ETF has stated that she hopes China's in there one day, because if China makes it in there one day, that means they've become more free, and that would be great for everyone. Taiwan, 16.79% in the index, 22.69% in FRDM. Poland is not showing on the list. Woo! So Poland is potentially hiding in there somewhere? I don't know. Where did Poland go? Let me check this one. Just in case I missed it. Exposure breakdowns, geography. Poland, not there. Interesting. I did not expect that. There's Poland. Yay! So Poland is 1.12% of the index when you exclude China. So doing the math, I want to do the math right now. It's low. Poland is pretty low on the list among the MSCI emerging markets. Now, it happens to be a developed nation according to FTSE. That's another oddball. Now, within FRDM, 16.58. Huge, overweight to Poland if you consider market cap weight to be sacred. South Korea, 15.52 here. And I'm going to make sure we use the right measure here. 12.32% for South Korea here, so South Korea gets more. Chile, this one I did expect. Chile, where's Chile? Don't know. It's something less than 1.56 because it's below Indonesia. It's somewhere below 1.14. Can I find it? No. So Chile's pretty low down there, but they're really free according to these measures, 14.53%. That should give you an idea of what is going on in FRDM. Personally, I'm willing to put my own money into that putting my own money into that because of what I think personal and economic freedom will do for investment returns. Is there kind of a social element to this in terms of wanting to do good? I think I would be lying if I said no, but I think there are good investing reasons as well. But you may disagree. You may disagree and say, hey, look, I just want to exclude China and just go with the MXC with this one right here. Let me expand this out. You may want to go with EMXC and just exclude China because China is especially bad. Or you could go with the plain old emerging markets ETF if you need additional emerging markets exposure because your 401k has that dreaded EFI index. You could even add Canada to it because there is a Canada fund, MSCI Canada. And then use a spreadsheet to get those all within proportion. Is it worth it for just one country? Maybe not. But this is potentially the importance of making sure that you have a way of looking at your investments as a whole rather than as individual portfolios. That's my point. MSCI Canada ETF expense ratio 0.50. Yeah, so I mean, with an expense ratio like that, and the additional complexity that would come with managing an ETF just for a single country, I'm sorry, Canadians, it just might not be worth it. But it's definitely worth when you are looking at international ETFs, make sure it's something that actually does the job that you're trying to do. IDEV would do the job if you're mixing with an MSCI index fund. This one here, whoa, no, go back because I took that from EMXC. EMXC would work if you want to exclude China. IEMG would work with MSCI indexes if you want all of the emerging markets, according to MSCI. And maybe this is just way too complex. You're like, look, just give me an international fund in my Roth IRA, and I don't want to worry about all this stuff. Okay, fine. As long as you're aware that you might be overweighting or underweighting certain things, then, hey, great. But avoid surprises and don't invest in things that you don't understand. There's all this information out there, ready to go. And if you're having trouble understanding it, leave a comment, and share this with someone whom you think might benefit from the information. I am Garrett O'Hara for Class 8 Personal Finance, and I'll see you in the next video.